this week's market update, attention focuses on changes to the Fed's monetary policy, another twist in the Brexit story, and China continues to soar on stimulus hopes. Central banks are the main focus for investors this week, with rate-setting meetings scheduled for both the Federal Reserve and the Bank of England. No change is expected from either of them for different reasons, but that does not mean that the meetings will be uninteresting. Far from it. Monetary policy remains a key market driver, especially the Fed's. Indeed, skeptics about the sustainability of the rally in share prices since December argue that it's all about an easing in the Fed's stance on interest rates, and that nothing more substantial than this has actually changed. They worry that without real progress on the economy and company earnings, the rally, which has seen the S&P 500 rise by 13% this year, will run out of steam. This week's focus will not be so much on interest rates, which are almost certain to remain unchanged at between 2.25% and 2.5%, but on the planned reduction in the Fed's balance sheet, so-called quantitative tightening. Since the financial crisis, the Fed has massively expanded the size of its balance sheet, buying government and corporate bonds in order to keep a lid on interest rates. This was quantitative easing, and it was widely credited with fueling the significant bull market of the last 10 years. Indeed, it was expressly designed to boost asset prices. It was always inevitable, however, that at some point the Fed would look to sell back its bond holdings, or at least let them mature without replacing them. It's already reduced the amount of bonds it holds from about $4.5 trillion to $4 trillion, and it had been expected to go much further with its tightening program. Last month, however, Fed Chair Jay Powell said that an announcement on the future of its balance sheet would come fairly soon. That came after January's change of tack to a more patient monetary policy. And it has raised expectations that this week's meeting will see a further policy update. Broadly, a pause of the bond sell-off would be taken well by investors and could give the New Year rally more impetus, perhaps taking Wall Street back towards the 3,000 mark from today's level of just over 2,800 on the S&P 500. On interest rates themselves, the odds of no change are currently close to 100% on the basis of financial futures prices. Far from the Fed raising rates a further 2 times this year, its own expectation, many in the market think one rise this year and another in 2020 is more likely. However, there's been a significant shift this month in the probability of a December rate cut at the end of the year. From being close to zero, the chance of a reversal in policy this year has now reached 27%. Still not the base case, but a meaningful possibility. On this side of the Atlantic, there's an equally slim chance of any change this week. The chance of the Bank of England raising rates on the day that Theresa May goes to Brussels to request an extension of the Brexit process is vanishingly small. Once again, real economic news like the trajectory of interest rates is being completely overshadowed this week by the ongoing twists and turns of the endless Brexit saga. This took a totally unexpected direction yesterday when the Speaker of the House of Commons, John Bercow, threw a spanner in the Brexit works by effectively banning the government from coming back to the House this week with a third attempt to drive through its withdrawal agreement with the EU. The plan had been to try one more time to get parliamentary approval before going to Brussels on Thursday to get a short extension of the Brexit process to enable the necessary legislation to be passed before actually leaving, probably at the end of June. But, citing a procedural ruling dating back to 1604, Mr. Bercow said that unless there were a substantial change in the nature of the vote, it could not be put before MPs again during the current parliamentary session. Similar bans have been enforced on a handful of occasions in the past 150 years or so. So, it now looks as if Mrs May is going to have to go to Brussels and accept what she and most Brexiteers don't want, a much longer delay to the process to enable a more far-reaching rethink of our Brexit approach. That makes a softer Brexit or no Brexit at all more likely than a couple of days ago. Given the significance of this week's developments, the market response has the potential to be greater than we've seen in the phony war so far, although so far investors continue to sit on their hands. So far, the stock market has held on to this year's gains, while the pound has hovered around the $1.30 mark. A clearer indication of where we're heading could see both of these break markedly higher or lower. Within the market, however, there continues to be a marked difference between the performance of international-facing FTSE 100 stocks and the more domestic, smaller companies. Ever since the referendum in 2016, domestic stocks have underperformed, and that creates a valuation opportunity if things work out for the better this week. That has started to be reflected in a modest reduction in investors' long-standing underweight to UK shares, although they still remain the least favoured region in the latest Merrill Lynch Fund Manager survey. Also in focus will be the government bond market in the UK. The outlook for gilts is actually cloudier than that for shares or the pound, because bonds are at the same time a reflection of investor fear and also expectations for inflation. For example, a no-deal outcome would likely see investors warm to bonds as safe haven assets, especially if the Bank of England responded with substantial stimulus for the economy, such as renewed quantitative easing or interest rate cuts. At the same time, though, a falling pound in this situation could trigger inflation, which is bad news for bonds. A softer Brexit outcome could, by contrast, reduce the port in a storm appeal of gilts, pushing prices lower and yields higher. A rise in the pound in this case might also reduce inflation. In a busy week for UK data, inflation is in focus tomorrow when CPI is expected to repeat January's sub 2% reading as clothing and household goods inflation remains weak. Below target inflation means that households continue to enjoy real increases in incomes as wages are growing at more than 3% currently. This week also sees an update on the jobs market, including wages, so the scale of that real growth will be confirmed. The final piece of key UK data due this week is retail sales. Now, looking further afield, the prospect of more stimulus from Beijing and the chance of a trade deal being struck between China and the US has led to another strong rise in shares in Shanghai and Shenzhen. The CSI 300 index closed up 2.9% on Monday, its largest one-day gain since February, and the highest level for Chinese shares since last May. Consumer stocks were the best performers, rising 5.6% on the day. Looking at the year as a whole, the index is now almost 28% higher, clawing back a large proportion of last year's heavy fall, as sentiment has swung back in favour of emerging markets in response to the more dovish Federal Reserve. China's Premier Li Keqiang added to bullish sentiment last week when he said the government still has the tools to stimulate the economy, and he said it will do its best to maintain stable economic growth. He also confirmed that tax cuts would come into effect in April. It's not just shares that are in favour either. After a difficult 2018, investors have also been pouring billions of dollars into emerging country debt, especially the so-called hard currency bonds that are denominated in US dollars.